Let's discuss the movements on the market further with Martin Smith from eNCA Capital. Martin, thank you so much for joining us this afternoon. The Rand, not looking good at the moment. What are the factors at play here?
It was looking good a week ago at 1750. You had some good news out of the US around CPI and market participants hoping that they're kind of towards the back end of raising interest rates there. You also had some news around South Africa and Russia and the BRICS summits. And then I think the other thing is fears around our power situation also seem to have abated. So that was last week. It's shifted today and yesterday, and you had some news out of Fitch with regards to US and downgrading their debt, which kind of sparked a market sell-off kind of across the board. You saw US equities being sold off, and you obviously saw quite a flight towards safe haven assets like the dollar. So Rand all the way back up to 1850, 1860. Look, maybe a little overdone. I think the market was looking for a reason to take some profit and some risk off after some of the moves we saw over the last couple of weeks. Still think that the Rand will trickle down to kind of 1750 in the short to medium term.
So you just spoke about the US's credit rating yesterday that caused the markets to go in a bit of a tiz, but the US also released some job data. What is this telling us about the world's biggest economy, and why is that also affecting all the markets today?
Sure. So, I mean, we had the jobs numbers out today, which is predominantly around kind of private big corporations. The big jobs numbers are actually out later this week, which is the non-farm payrolls. And I think that's what the market really looks towards. And again, it is important because if you look at the Fed and their mandate, they've got to look after, one, inflation, but secondly, about what's happening in the job market. And if the job market is really strong, like it has been, they've got a little bit more rope to kind of put interest rates up a little higher. So it's a bit of an interesting one. When you have good job data, it's kind of bad news for markets, and good news is bad news and all of that. So again, I think the market and the Fed are looking to any piece of information they can get around the economy and how it's looking with regards to inflation and the like. And again, I think market participants are just looking towards that. But again, the big number is going to be what comes out on Friday and how that'll affect the Fed's decision from an interest rate hiking perspective going forward.
On the company side, AB InBev released their results today, and earnings were much more than expected. Why?
So I think you had two forces at play here. You had 20+% growth out of places like Colombia, Brazil, and China, which is very positive. You had lackluster growth in the States, which was down 28%. Overall, though, it was a much better than expected number, and I think the US was better than people feared. So that's kind of what happened there. They also maintained their longer-term guidance for the end of the year, which is 4 to 8% EBITDA growth. So positive from that perspective. I think if you look at AB InBev, looking quite cheap from a share perspective. They do have some good things coming through from kind of, again, those South American regions and Central American regions. But again, all comes down to what happens in the US from a volumes perspective going forward. So I think one to be patient with, even though it is doing good things in certain pockets.
So in a trading statement this week, OUTsurance says they're expecting strong earnings growth and they're busy expanding into the Irish market. That's quite interesting.
Yeah, absolutely. So a better than expected update from OUTsurance. The Australian business was quite a big component of that, and it's predominantly quite a volatile kind of market for them. So that was quite positive there. I think the share didn't react too much, even though the results were very good, because it is a share that is up 20% year to date and probably looking quite full from a valuation perspective. But overall positive. Yes, they've got the Irish expansion coming in the second half of next year. Remains to be seen how that plays out. They've obviously done quite well, like I mentioned, in Australia. Other places like New Zealand may be a bit more challenging. So I think the market will wait to see how that actually unfolds and how it actually impacts the income statement next year and the year thereafter.
Thank you so much for your time, Martin. That was Martin Smith from eNCA Capital. Back to you, Marcel.